Welcome to Old Fashioned Finance, the podcast that mixes cocktails and high finance. I'm your host, Caleb Frankert, and I'm joined by my good friend and fellow money muddler, Jason Burnell.
Caleb, can a podcast about finance be entertaining?
Not without alcohol.
Well, all right, let's mix it up.
Woo!
Yeah. Dude, this is exciting.
I know.
I don't know.
Can
It's
hardly
fall.
contain myself.
It's harvest time. Oh, it's crisp. It's crisp.
autumn.
outside.
You're like, it's autumn. It's harvest time.
Oh, I didn't
it's
even look at the
tequila
name.
time.
It's tequila time.
We are drinking Autumn Harvest Mezcal cocktails.
Ooh.
Jason,
Nice.
what is a mezcal cocktail? What's mezcal?
I don't even know.
Oh, you know this.
Oh my gosh. I'm a bad half Mexican.
So I don't. Mezcal is
It's a drink, isn't it?
It's a term that gets thrown around. It's a liquor with
Agave liquor.
agave liquor. Yeah,
That's right.
So
We did
I mean tequila, right?
Yeah. I mean,
I don't know of any other ones other
well,
than tequila.
We did look this up. I remember now. There are other agave liquors, but tequila obviously
know,
the most loved.
I mean, it's interesting. Down the road, Flat Rock Distillery,
Yes.
our friend Lawrence,
Mm-hmm.
he was on Moonshiners,
Yes.
right? On was it Discovery Channel?
Yeah.
And that was the contest one where so he was in a competition and he had to make mezcal.
Ooh.
And he was like, "Man, I've never made it before, and so I just had to do it on the show."
There are lots of agave liquors. Lots.
I
I'm
don't-
looking them up right now.
Tequila definitely is the
Oof.
main one.
Now I'm
right?
curious. I think we might have to explore this a little more.
I'm for it. I like tequila. I'm guessing that's the agave that I like, right?
Yeah.
Well,
Oh.
and like agave, we've had the agave nectar and cocktails before.
Which that's how I like one of my favorite margaritas is with straight up agave.
That's pretty sweet.
It is.
Yeah.
It is. But I mean, I don't put a lot in there.
Yeah. Well,
It's all right.
you don't normally think of autumn or harvest when you think of tequila. Or mezcal. But I mean, that's just me, because I drink like margaritas and
Mhm.
sometimes just tequila by itself in the summertime.
Yeah.
But let's see. I think it might be good in the fall. I don't know.
These ingredients have our attention. There's no doubt.
Yes. Let's get into that. I guess we're blowing right past the small talk today,
That's
aren't
all right. Whatever.
we? The Autumn Harvest Mezcal cocktail. This is another one that I found on OHLQ's website. That's
Nice.
our Ohio Liquor Control. One of their many fall recipes. The one we had last week didn't make any sense to me why that was a fall recipe.
And it was disgusting.
Yeah, it wasn't great. This one, now it was a cool looking drink. We'll
It
say
looked
that
nice.
much.
This one looks awesome though too. So.
Yeah, this one I could imagine. I mean, this one makes sense why it's other than the tequila, it's screaming fall. So what we're drinking here has 1.5 ounces of mezcal. So we use tequila.
Tequila.
Half an ounce of fresh squeezed lime juice.
Mm.
You don't have a song for that?
No.
Okay. Half an ounce of fresh squeezed lemon juice.
Yes.
2 ounces of apple cider.
Now you got me.
Yeah. Half an ounce of maple syrup.
Mm.
And we're going to garnish that with an apple slice and a cinnamon stick.
See, not all our listeners know. I mean, my affinity for the pumpkin spice.
Yes.
I mean, I love this.
Yes.
This is all the spices in the pumpkin
This
spice.
just hang on because this will not be the pumpkin-y, spiciest
I don't know.
drink that we drink.
The lemon juice has got me concerned, but we'll see.
So you got the citrus and you got the tequila, but otherwise it sounds fall and it looks fall. Let's give it a try here, Jason. Cheers.
Did you say cinnamon stick in there? I don't know that you said that. Did you?
Mm-hmm. Huh. That's interesting.
Oh man,
That's interesting.
I like that a lot.
That's pretty good. You're drinking tequila.
Yeah. Oh man,
You got the apple cider
that's
in there
sneaky
for
right
sure.
there. There's an ounce and a half.
Oh man.
of tequila in
You
there.
know what, Jason? Actually, this
Ooh.
immediately reminds me of and maybe I didn't say how we made this drink. So we combined all the ingredients minus the garnish in a cocktail shaker with ice. Shook
It's
it up
cold.
and strained it into a glass, like a martini glass or a cocktail glass. It's cold. However,
Did they say to make it with ice?
yes,
Okay.
I could see warming
Warming
this up
this thing.
over the fire,
Yeah.
sitting outside watching a football game, projecting a football game.
Yeah.
Have a big batch of this stuff.
I think we might
Ooh.
have to put this in a mug and warm it up.
You know what? And can you imagine throwing the cinnamon sticks in there while it simmers over the
Maybe
fire?
a few cloves.
Ooh.
Ooh.
Now you're getting a little.
Oh.
Now you're getting greedy, Jason.
Oh, well, all those things I love so much.
This is really good. I like it. I think this would be a winner in most circles, whether you're a cocktail fan.
The alcohol is not screaming through. You definitely taste tequila, but it's really, really smooth, and it's not overly sweet. I was worried about the lemon juice, which I
think it plays nice.
It does, actually. The lemon and the lime, I think, is what you're trying to. But that's a tequila thing. I get it.
Yeah,
so.
I wonder with some of the drinks that we've had, Jason, the lemon juice has taken over, even small amounts, like last week. I wonder if there is something to do with the lime juice in there, if it counters it.
Well, even even the apple. I mean, that's a fruit there too. Like it's another way to maybe calm it down so much. I mean, I don't know. This is really good. An excellent drink.
This is like a fall margarita, if you ask me.
It is. Yeah, that's actually a better description than
I think
autumn harvest mezcal.
Yeah, if you like margaritas, and I would say that you don't have to like cocktails to like margaritas.
No.
I think that's a pretty popular drink, and you just want to kind of spice it up with some fall ingredients. There you go. Right there it is, Jason.
And I will say this
margarita.
again. A lot of our tequila drinks we have, don't skimp on your tequila. Like don't you get the bottom shelf stuff. It'll make you real angry. So
since we said this is very reminiscent of a margarita and could be a fall margarita, I really wonder what it would if we had like some cinnamon sugar. What's that? The cinnamon sugar and maybe some like ground nutmeg or something.
on the rim.
Yeah, like you would salt a glass.
What if you dipped your rim in maple syrup and then put cinnamon in
sugar? Wow. We have to try that.
Oh, yeah.
We have to try that after.
Okay.
No, we better not. I was going to say, we can pause and try that. No, we'll experiment with that off.
Yeah,
off
that
air.
sounds like a great idea.
It really does. Don't forget that.
I won't.
I like
Trust
that.
me, I won't. I love cinnamon so much. I put cinnamon in my coffee every day.
You do?
Every day at home.
Oh.
Yeah. Love it.
Interesting. Well, this is good. You know what's not good? Being blindsided by taxes. Here we go again. All right,
okay,
Jason.
yeah.
Today
could blindside you, or
today on the podcast we are talking about
gluttons for punishment.
We are, but this is
really important.
Year-end capital gains distributions, Jason.
Okay, so we are sitting at the lunch table, and it was kind of like, holy crap. This might actually really make a huge difference in some people's situations.
This is a year, as we get into the details, we'll kind of explain why, but this is the year that this really, I could see being a perfect storm for this kind of a situation, Jason.
For sure.
So I won't blow it as far as what the perfect storm looks like yet, but yeah, it does have you wondering. The good thing about this is a lot of these mutual fund companies are posting their expected capital gains distributions. However, it's not an exact science until it happens.
It isn't.
But let's get into what we're talking about, Jason. So first of all, for our listeners out there who have tolerated us talking about fall drinks so far and are still with us, who does this affect, Jason? It's not IRA clients. It's not 401k folks. It's not Roth IRA clients. It's people with
non-qualified money. Okay, so
simply put,
that's just regular cash.
After-tax money.
After-tax money. You could have it in a trust account, right? That's a whole nother scenario. Corporate accounts, those kinds of accounts are the ones that we're really talking about here.
Yeah.
And the reason for that is, your qualified accounts, the IRAs, 401ks of the world, distributions can be made into the account, cause capital gains, and you don't pay any taxes on those on an annual basis.
Doesn't matter because it's all coming out as ordinary income at one time.
Correct.
Or another down the road.
So those are not the biggest concern. So if all you have are qualified retirement accounts, just turn off the radio right now. I'm just kidding. You can listen.
Well, I would think that if all you have is qualified accounts, you'd like to get to the point where you have non-qualified.
That's right.
too.
So you need to know this stuff.
But yeah, when we say qualified and non-qualified, remember we're talking about retirement versus non-retirement in a nutshell. Okay. So who does it affect? Folks with non-retirement investment accounts.
Correct.
So let's talk about kind of the nuts and bolts a little bit, Jason, the mechanics of all of this. So in this case, we're talking primarily mutual funds. That's the big one, right?
Correct.
because when we're talking capital gains, let's be real simplistic here. If you buy stock in XYZ company and you paid $100 for that stock, and 2 years down the road it grew to $200 and you decide to sell it, you have a $100 capital gain.
Correct.
It's a long-term capital gain, so you'll be taxed at long-term capital gains rates. That's pretty simple because as an individual stockholder, you're in control of when you pay taxes on these types of gains, right? But let's talk about mutual funds. And by the way, we're not going to dog on mutual funds as far as an investment vehicle because they are appropriate for a lot of folks, right?
Definitely.
Most people can't go out and build a really diversified individual stock portfolio, so they turn to mutual funds.
Right.
But this works a little bit differently, right, Jason?
Absolutely.
The mutual fund issues shares in their fund.
Correct.
They own the individual holdings. You own shares of the company.
Correct.
Right?
Of the mutual fund.
Of the fund, exactly.
Right. So you got this big bucket of stocks
Mm-hmm.
that a mutual fund manager is managing to an objective.
Yes.
Right. And they're throwing stocks in there and buying and selling
Mm-hmm.
based on what they believe in. Correct.
Correct.
We hope at least.
I wonder about some of them these days.
Well, they're filling the they're trying to meet or fill the objective of the fund. So if it's a growth fund, it's going to be growth oriented. And
right. And generally, taxes are a secondary objective in a lot of those types of funds, right?
Right. I mean, almost
managing
always.
tax bills. Exactly.
But this year it's going to be unique. There's no doubt. So
yeah. So let's talk a little bit more about the mechanics here. So if you buy a mutual fund, right, and you paid $100 for your share in the mutual fund, and that net asset value goes up to $200, and you decide, well, I don't want to sell this yet, so I want to avoid my capital gains. That's not necessarily what's going to happen, right? Because the mutual fund and the manager really is tasked with buying and selling stocks in that portfolio to achieve those objectives that we talked about.
Yep.
And as they do that, there are taxable events occurring inside that portfolio, right? So you may or may not sell, but you're going to have a tax situation.
So by law.
Yes,
Okay.
by law.
The mutual fund are required to make regular capital gains distributions to their shareholders.
And by regular, typically that's annually, right? At least.
Yeah. I mean, I think they're going to be held to that standard.
Mm-hmm.
So if they sold a stock, made a profit, they have to distribute some of that gain.
Yes.
Okay. Now, you might say, oh, great, I made some money.
Yeah. I'm okay paying taxes as long as I made money.
I made some money. I put it in my pocket. Most people don't even realize that these distributions occurred because most folks reinvest their distributions and dividends.
Well,
right?
and what happens oftentimes because of that, Jason, they get a 1099 at tax time.
Yep.
That shows that they made money in a mutual fund, and they go, well, okay, I didn't sell anything, I guess. But hey, I also see that my cost basis is now higher, right?
Yep.
Because you paid taxes. So whenever someone goes to sell that mutual fund down the road, typically they're looking at their capital gains when they sell out of the fund being less than what they'd expect, right? Like they might have started with $10,000 in that fund and sold it for $5,000 or a $5,000 gain from where they started. But along the way, they'd paid capital gains taxes through these distributions, right? So you get a cost basis update when you go to sell, and it says, oh, your cost basis was $12,000. You get to pay taxes on 3. You go, well, hey, I bought the fund at 10. It says my cost basis is 12. How did that happen? Oh, right, because of these distributions throughout time. So not to bore everybody with all of that, but that is how, you as an individual taxpayer, you have some control over when you pay capital gains. But let's talk about, and by the way, so one of the perks to this, by the way, is if you bought into a mutual fund January 1, and then you sold it in December, and you had gains, right? So well, I should take that back. Let's say it's a year out, right? But there's something in there that the fund bought in July, right? And there was a short-term gain there. All of those gains, you get long-term treatment on that.
Yeah, exactly. So yeah, it's a little bit in the weeds on, like the specifics of how they buy and sell. But, I think this year, we're recording this, it's 2022.
Well, let's set the stage for 2022.
Okay.
Because what happened
leading up to 2022.
Leading up to 2022, Jason, let's go back and look at some of the major market events. So we had the COVID crash, and then recovery, really, new highs pretty quickly after that, right?
Yeah, and really, we've had a pretty long period of time.
Go back before COVID, right?
Right.
Like we're talking about gains and a lot of these funds
Could be 10 years old.
Yeah, plus.
Right.
Right. So here's the scenario.
So let's make assumptions. We have 10 years worth of gains.
Okay.
Mutual fund is at least 10 years old.
Yep.
Okay. So 10 years worth of gains, and we enter into 2022 with we have 10 years worth of gains loaded up in the fund.
Yep.
And then what happens this year?
Well,
we've had an extended period of selling.
We woke up the bear.
Right. So 2022, no surprise at this point now, is that we have a negative market.
Yeah.
And we're down a lot.
Well, okay. And
we're bear market territory.
And let's also talk about what people do that they shouldn't do when they're down, which is sell their mutual funds.
They sell. So people get real scared.
Mm-hmm.
And the retail investor especially runs for the hills, and they redeem their mutual fund shares, and they get their money out.
Yeah. So there you said it, right? Let's say that even if the stock values in that portfolio remain at a certain level, right? Yep. But everybody's just scared. There's negative sentiment, and people start bailing on mutual funds. They start selling. That mutual fund has to raise cash. Now they're sitting on cash for redemptions, of course, but
probably not enough.
Right. When you go through a period like we've gone through, where we've been, for the better part of the year when did we hit bear market territory? Close to 6 months.
Yeah.
Right. So you got people selling.
Yep.
You got people taking cash out of the funds.
Yep. The fund is required to sell positions that have
What do you do when you're out of cash? You start selling. You start selling stuff because you have to meet redemptions.
Well, and
right?
they're required to maintain cash levels. I mean, it's not like they can spend their savings account and ride the line. They have to refill that bucket and then be ready for more redemptions if they come in.
So let's think about it this way, right? The market's down this year, and we've given up. So we gave up all of the gains that we had at the beginning of the year, of course.
Sure.
If you go back, even over the last couple of years, wiped out a good amount of those gains too.
Yep.
But if this mutual fund, let's say, is holding on to gains that are 10, 12, 15 years old, those gains are still they're still in positive territory.
Correct.
So they're selling winners to meet redemptions.
Right.
Okay. So let's say mutual fund investor got in the market this time last year, and they've waited a year to sell, and now they've had enough. They throw in the towel, they sell. They've never made money in this fund.
Never made money.
But we're selling companies in that portfolio where the fund is showing gains, right?
Correct.
Who gets to pay taxes?
So you're saying this investor has held on, is still in the fund.
Yeah.
And come January 1, he still owns the fund.
Yes.
Okay. Hasn't made a dime in the fund.
In fact, has lost money.
In fact, has lost, let's just say 20% this year. But because the fund had to meet redemptions, they sold some of their winners, which created a capital gain, which he now has the privilege of paying taxes on.
Even though let's call him Jim.
Even though Jimmy Boy lost some money in the market.
He never took part in the winnings, right?
Never took part.
Okay, so never took part of any of the gains. Now he gets to foot some of the bill for the taxes.
Correct.
Right?
Yeah, so
This is the perfect storm we're talking about, by the way. So we get the double whammy, right, Jason? Market's down, sentiment's down, people are negative. We're starting to hear people grumble about the economy.
Yep.
And if they don't look into this stuff, or more importantly, their advisor doesn't tell them, hey, we have a situation.
Right.
Tax time rolls around and they get the other kick in the pants.
Right.
Not only did you lose money last year, and you probably, maybe you bailed even on the investment, now you get to pay taxes on gains that you didn't take part in.
Correct.
Right?
Yeah. And so there are some really important points here that, I think you hit a good one. Most of the time, this is a surprise.
Yes.
Okay.
Why is it a surprise, Jason?
Well, because nobody talks about it. So if you own any mutual fund right now, okay, there should be some research being done around what are the planned distributions. And so what's the record date, the distribution date? When are they actually going to do some of this stuff?
Yep.
Because making an exchange into something different might actually cause you to avoid this distribution and the heartache of a surprise.
So you said it right there, exchange. We are not advocating to bail on your positions now.
Not at
This
all.
is a bad time to sell. So yeah, but exchanging into something else, right, where you can take a little bit of control over your situation and take some of these capital losses that you have that maybe offset some other gains. But yeah, if you're holding at that dividend date, at that gains distribution date, you're holding the bag. Now, here's the thing. Nobody should be surprised because these mutual fund companies about this time of year start reporting or estimating how much they're going to be paying out in these gains.
I just was reading a whole bunch of them, and they're significant as a percentage of their price right now. I mean, like 20% of the share price. That's big. Huge number. So if you have a mutual fund that's at $20 or $100 a share, they're going to give you a distribution of $20. Okay, and you got to think that's.
And you might not have seen that in your share price or in your principal.
Well, and
the
let's
uptick,
just take a practical
from
case.
a tax standpoint, you get to claim that.
Yeah. So let's say you have $10,000 worth of that mutual fund, right? It's going to distribute $2,000 in capital gains to you. All right. And if you pay 10, 15, or 20% of that, I mean, we're talking $400.
Yeah.
And you
in a year that you lost money.
So you might have started with 10 and you might have 8 now. You know?
And let's be realistic, Jason. We're not talking about this being a huge problem for someone who has $10,000 in a mutual fund. But what about someone who has $200,000?
Right.
$500,000.
$500,000. $1 million.
Right. We're talking about a big issue here. Right.
So if you have a portfolio that's loaded up with mutual funds, again, I think there's some homework here. And this is like, I think we rarely say like, sound the alarm. It's time to take a look at this. And I think even to a certain degree, this kind of caught us off guard. We were thinking about it.
There was talk about this last year even.
So to be clear, as advisors, we mostly use ETFs. Some ETFs have distributions. I don't want to get in the weeds of that.
Not very often,
but not as much as a mutual fund would.
Right.
And will.
Well,
year.
and like you said, they're mandated to make these distributions. And maybe that's a good podcast, mutual funds versus ETFs, if you like that boring stuff.
We love it.
this is one of the reasons that we primarily use ETFs in our portfolio. And that'll be one of the things that we get into when we talk about avoiding these types of things, actually.
Right.
But yeah, this could be a real perfect storm, a real catch you off guard kind of a situation. This is where I think as advisors, we can really add value because, look, here's the deal. Just being honest, this year's been a tough year.
Right.
This is the perfect storm year. I'm going to throw that term out again, where I've told clients for a few years now, be prepared. There will be a time when we probably will lose money in stocks and bonds. Be ready for it.
Right.
Okay. So we're in that situation where bonds didn't counteract the risk that we were holding in stocks. We're down. Everybody's down. Right. And then on top of that, well, we know we charge a fee. We still manage money. We still charge a fee. Do you really want the triple whammy on top of that? We lost money, you paid a fee, and now you get to pay taxes.
Right.
Ways that we can add value as an advisor, I think, is, hey, it's October, right? You got time to think about this. You got time to look at this.
You got
talk
time
to a financial advisor.
You can be off the record for this distribution.
Yeah.
Because again, like you could buy $100,000 of a mutual fund today.
Yeah.
And they announce their record date is November 20 whatever. Okay, 7th. If you own that mutual fund on November 27th, you're getting the capital gains. And you owned it for like less than a month.
And let's not forget the fact that the net asset value price, the price that you track that with, right?
Also gets to go down.
Comes right off the top of that, right? Similar to a dividend and a stock. But
yeah, I think one last point here that I think is really important. We've covered most of this other stuff is the tax loss harvesting.
Well, hold on, because we'll get into that actually.
Okay.
I guess the last thing I was going to say about...
Oh, another last thing.
Yeah, the last thing I was going to say about adding value and what you can do now because it's October. Like if this podcast came out in December, or if you're listening to this in December, sorry. There's time to do something about it. And I'm telling you, like we've been saying all year, this is a great time to get your financial advisor and your tax person talking to each other.
Yeah, that is a good point.
For lots of reasons.
That's a really good point.
So this is at heart a tax issue, near to my heart.
Of course.
let's shift gears, Jason, because what we were going to jump into here is what can you do to avoid this stuff?
Right.
So we've
We covered
alluded
a
to
few
some of
these.
it.
Yeah.
I think one, be aware, which is what we're trying to do right now, is make people aware. Right.
And this is something, guys, that don't put this on your to-do list to never be forgotten, about. It's like in the next month, you need to be really digging into this because it's going to happen pretty quick.
Yeah. So, and not only be aware that these things are going to happen, go check out, if you have a mutual fund, all of them, and see what their projected distributions are going to be. Now, it's just projected, because if selling would continue and they need to meet more redemptions, it could be higher. But it should give you a pretty fair idea of where you're going to be. So start planning now. Start talking to your advisor, your tax person now, right? And you were just talking about this a minute ago, but when you purchase, look into these things, right? Because you might be sitting back saying, hey, you know what? I've got a bunch in cash right now. The market's selling off. This could be a time to get in. Hey, it absolutely could be a good time to get in. Just make sure you're not stepping into a bear trap here.
Right, exactly.
Right, and you own a mutual fund for a week, and then you get to pay a big capital gains tax on a distribution, right?
Exactly.
So be aware when you're purchasing, and also, this is not just an end of the year kind of a thing. I was checking up on a fund for a client a little bit ago who merged. This mutual fund family merged with another family. They paid some of their distributions at that point to kind of even it out with the different shareholders of the different fund families.
Yep.
So some of them will pay multiple distributions throughout the year, and some of them are just off the wall, one-off type of situations. But you got to be aware when you're buying a mutual fund that this is a thing, right? And in a year where it's amplified, a down year where the selling is occurring, right?
Exactly.
The next thing I have on here, Jason, looking at turnover on funds. This information is out there.
All over the place.
Morningstar's a great resource.
Every fund company has it on their website too. I mean, if you look at, Vanguard, you can see the turnover of those funds.
So, Jason, when we're talking about turnover,
how much buying and selling is this fund doing? Okay, so if you have $10,000 in a fund, if you trade 100% of the fund in 30 days, you would have traded $10,000, right? So
there's going to be some taxable
events, probably short terms, right? But some funds do trade 500% in a year. They turn the thing over all the time, which is going to create significant tax situations.
And look, that's not horrible. We have some high turnover ETFs, but the benefit should outweigh the negative here.
Right.
When you talk about turnover, so like funds that don't have as much turnover, typically like an index fund, a more passively managed mutual fund, typically. So yeah, turnover is a big one, because turnover to you should mean higher likelihood of paying taxes. I'm going to let you talk about this one because I kind of stopped you in your tracks, but tax loss harvesting.
Right. So, I mean, we have an opportunity right now where you can offset some of these capital gains by selling some losses. Okay. So now I think people get confused that it's only $3,000 a year. You can offset a lot of gains. You can only claim $3,000 worth of losses
above and beyond.
Yes. So if you have $100,000 gain and $100,000 loss, they can offset each other.
If you do, by the way, do it.
Yeah, exactly.
This would be a great year.
So that's an important point. But in that same vein, you could also just change the funds around a little bit and avoid the distribution.
Right.
Change from a mutual fund to an ETF. You could do that.
Yeah. And that's the last point that I had on here, using ETFs, because traditionally speaking, they're not mandated to do these distributions. And the way that they're traded, this is good for another episode, I think. But you're just not going to run into this typically with ETFs. Right?
Exactly.
And we had a conversation with a guy who has worked in the mutual fund business for his whole career. And he's saying if these funds don't get moving to ETFs, right, there's going to be a day where they're
resting on their laurels, basically. It's not good.
So, yeah, I think this is a really good and timely episode. Yeah. I think that the moral of the story is be aware and don't be afraid now in October to get your financial advisor and your tax person on the same page, because you don't want to be caught up in the perfect storm.
You need to share this with your friends and family because this is an important one.
Absolutely.
Yeah, give us 5 stars. Whatever that
too. We don't ask for
Thumbs
that
up.
very often. Yeah, rate our
this
podcast.
This is important.
But yeah, like you said, and this kind of gets into our disclosure, someone you love or someone who needs a little money muddling themselves.
That's right.
If you know someone who owns mutual funds, they need to hear this episode. Friends don't let friends own mutual funds. Ah, boy, that's wrong. All right, well, thanks for having a drink with us
sponsors.
this week. It's time to close out the tab. If you have a question or a topic you want addressed on the Old Fashioned Finance podcast, be sure to email us at podcast@bluejfg.com. We'd love to hear from you. Don't forget to share the show with someone you love or just someone who needs a little money muddling themselves. You can stay up to date with the latest action by following us on Facebook. Old Fashioned Finance is brought to you by Blue Jay Financial Group. That's bluejfg.com and produced by Podastery Studios. We've been your hosts, Caleb and Jason. Cheers. Blue Jay Financial Group, LLC. Blue Jay is a registered investment advisor registered with the state of Ohio. Registration does not imply a certain level of skill or training. The presence of this advertisement on this podcast shall not be directly or indirectly interpreted as a solicitation of investment advisory services to persons of another jurisdiction unless otherwise permitted by statute. Follow-up or individualized responses to a consumer in a particular state by Blue Jay and the rendering of personalized investment advice for compensation shall not be made without first complying with jurisdiction requirements or pursuant an applicable state exemption. All verbal and written consent on this presentation is for information purposes only. Opinions expressed herein are solely those of Blue Jay unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.
I have lots of gains in my waist right now. You know that?
Yeah.
Is there any way to do a loss harvest on that?
I don't know.